Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. We're excited to have you. Josh Knoll here. Regular co-host Michelle is off playing hooky again this week, but she will be back next week in her place. Regular fill-in co-host, a lot of listeners will recognize JD Gardner, the founder and CIO of Aptus Capital Advisors. JD, how you doing?
I'm doing good, Josh. Thanks for having me.
Well, thanks for coming on short notice, man. We've been working on this for a while, but you've been busy.
It's been a little bit hectic out here.
That's right. Listeners, JD and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store. First segment, deep dive on our topic of the day. Second segment, about 25 minutes past the hour. That'll be news headlines of the week. And there's some doozies in there, I won't tell you right now. Then roughly 45 minutes past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. And with so many people in the media offering up stock market predictions and advice, I think we're going to have some fun with that one. So buckle up. We got a lot to get to. Quick background on me for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That's an independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website. That's gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. Now, if you just missed that contact info, grab a pen and pad. We will repeat it several times throughout the show. All right, and also, Jay, I'm going to do a quick disclaimer to help listeners understand the role of Aptus with Gulf Coast Financial Advisors. As I mentioned in the opening, JD Gardner is the CIO and founder of Aptus Capital Advisors. JD also holds the credentials of CFA, Chartered Financial Analyst, and CMT, Chartered Market Technician. JD's firm, Aptus Capital Advisors, serves as a sub-advisor to my firm, Gulf Coast Financial Advisors, which means, in plain English, that Aptus helps us, our team, with our clients' investment accounts, portfolio construction, trading, a multitude of other services that they provide. What it does not mean is that JD or Aptus is employed directly by or for Gulf Coast Financial Advisors. JD's advisory services are offered through Aptus Capital Advisors, a registered investment advisor, registered with the Securities and Exchange Commission, and based in Fairhope, Alabama. Aptus and Gulf Coast are not affiliated. All right, we did that for the compliance right there, right?
Perfect.
All right, back to the show. Now, JD, last time you and I were in studio, the stock market was on a tear. We both agreed that it was reacting very positively to the then recent election of Donald Trump, and all indications were that investors were headed maybe for some smoother sailing after experiencing so much volatility, but a lot has changed since then. Instead of smooth sailing, we've had, I would argue, probably even more increased volatility as the markets react to President Trump's various tariff announcements. We've got some stubborn inflation numbers. We've got uncertain geopolitical situations. So what I want to discuss with you today is a little deeper dive into why the market is experiencing all these up and down gyrations, but more importantly, what can investors do about it? Can investors do anything with their investment portfolios other than just hang tight, right? So that's a question JD and I are going to answer or attempt to answer today. Let's start with this, JD. I think anyone that pays attention to the major factors behind the recent stock market volatility will understand that, again, we've got tariffs, we've got inflation, we've got interest rates, we've got Russia, Ukraine, we got all these things. I think what they may not understand is the history of stock market volatility, because while these issues in and of themselves may have some slight uniqueness to it, the history of the world has been there's a lot of uncertainty. So let me kick off our conversation with a question to you. Mentioning history, they say history doesn't repeat itself, but it often does rhyme. So do the recent wild swings in the market have any historical context, or are we just in completely uncharted territory?
Definitely not uncharted. I think so. The recurring theme that I'll probably hit on a bunch in this conversation is Yeah, but does it matter? I think a lot of investors, the short-term stuff, the tariffs, the volatility that could happen today or next week, should that really impact a plan and how you approach portfolio construction and thinking about your investments? I'd say the overwhelming majority of the time, the answer is absolutely not.
Okay.
So typically when you see a pullback in the equity markets, and I'm not the person that's going to tell you, hey, when stuff gets rocky, you just don't look at your statement, sit tight, don't do anything about it, buy, hold, that's it. I'm not that guy.
We're going to have more solutions than that to discuss today.
Correct.
Right.
But I think the biggest thing is I am, and we'll talk about these reasons, I'm sure, I am an advocate that, risk assets, meaning stocks, tend to go up, and there's enough reasons to believe that, sure, we might hit a patch of volatility, but we are going to be like, my single question is, hey, in 10 years from now, do you think equity markets are going to be higher than they are today? I would argue most people are not going to say, no, I think they're going to be lower. And
right.
So you need to invest that way. You do not need to be investing based on what you think could happen because of tariffs or because of any political decision. So I think that this is not uncharted territory. The best time to get into the market tends to be times when you've got a pullback, and we hit 10% here recently, which is not anywhere close to out of the norm.
Well, JD, so a couple things. One, we're going to actually briefly talk about the stock market history over the last 50 years, a little bit of a short rehash of some research I did for a previous episode on the major indexes. I don't know if you saw that. I sent that to you. And number two, question as we lead and keep moving forward is, would you agree that fear sells?
100%.
Right.
Most of this business is built on selling fear. And is it the most productive thing to do? Absolutely not, but it does sell.
Right. Because, folks, I can tell you one of the main, call it tenements or points of doing this show was I always felt like there was a lot of information out there intended to both cause the average investor to have some fear, and also, too, I think in a lot of regards, have the average investor have a lot of confusion. How many times have you heard an investor say, well, I don't understand what I'm holding. I don't understand what the point of it is. I don't understand any of this. I've argued that when that does happen, our role as advisors is to help clarify that. However, I don't know if you agree or not, JD, but there's a whole segment of our industry that tends to kind of just continue to stoke that confusion. And often it's done in regards to sell a product or service. Am I off base there, or do you think I'm accurate?
No, I could. There's so many investors that we speak with that they want to be conservative. They're concerned about things. Therefore, they're going to sit in very conservative investments, and they let fear kind of dictate what their allocation should be, even though they have risk capacity and they have the financial capacity to absorb risk and think long term. And they sit on the sidelines when you have the market compounding at double-digit rates like it has for the last, X amount of years. And so I would say, like, to put some numbers to this, and I know you've got data as well.
Oh, it's funny, data, actually. Yes, sorry.
You see a 5% drawdown or more, about 3 times a year.
Okay.
You see a 10% drawdown about every 16 months. You see a 15% drawdown or more about once every 3 years, and a 20% drawdown or more about once every 5 years. So, if the market is going to, if you're so concerned about a 20% drawdown in the market, you're going to, this is my opinion, but I think you're going to do more devastation to your ability to grow your wealth by trying to sidestep a 20%, and you lose sight of, if you've been invested since, what has the market done for the last 10 years? I mean, it's been outrageously productive.
Right.
Just to say, I'm not even going to be concerned. 2022 was terrible, but 23 was great. 24 was awesome. So I think investors need to not lose sight of that and get sucked into this kind of fear. Well, let me just park my money and I know it's safe at that point. And I've got a whole lot to say about what safe actually means.
What does safe actually mean? Well, let's talk about that. So as we're recording this, the major indexes, I'm just going to give some folks some numbers for reference as I go back in history a little bit. And I will preface this by saying, as JD and I always have to say, all investing involves risk. And a lot of this stuff that we're going to discuss is going to be it's going to be pertinent to a risk tolerance and time horizon conversation. That said, right now, JD, the Dow Jones, which some would argue is a little bit limited view of the market, we're sitting a little bit under 42,000. We got the S&P hovering around 5,600, and we've got the NASDAQ composite around 17,600. So the reason I mention that is I want to give some context. You're a little bit younger than I am. I was born in the mid-'70s. So I really didn't start paying attention to money at all other than listening to what my mom and dad had to say about it until I was probably 5, 6, 7 years old. But just to have some fun, I just told you that the Dow Jones, even after this steep decline, is sitting around 41.5, 41.6. Do you know what the starting value of the Dow Jones Industrial Average was in 1980 when I was 5 years old and you probably weren't even born yet?
A whole lot lower than it is today.
824.
Yeah.
Okay. The NASDAQ composite, which is even more hilarious, was sitting at 164. And I just told you, listeners, NASDAQ composite is 17,600. Now, does that mean that the NASDAQ composite, you would have made a 17,000% return since 1980? No, that's not how the market index works necessarily. But what it should give you is some indication of what JD was referring to a minute ago is trying to time this thing. There is an opportunity cost to it. So today, what we're going to try to talk about with all of the recent volatility is balancing that market, that opportunity cost, balancing that with not just being a blind buy and hold per se investor, while also talking about what is actually the definition of safe. So, JD, if I were to told you in 1980, you weren't born yet, somebody came to me in 1980 and said, hey, kid, if you'll give me a dollar into this NASDAQ composite, guess what? When you're 50 years old and got gray hair, this thing is going to be, the number multiple on your return is going to be exponential, like bigger number than you can even think. Would you have considered that safe or not? Well, looking back in time, that you would argue that was actually probably one of the safest things to do. Yet advertising and marketing and fear selling tells us that that's the opposite. What do you got to say to that?
The first thing I have to say is, you have, and this is what we do. We deal with financial advisors predominantly. So folks that, have kind of an awareness and an education more so than the typical.
You would hope so anyway.
You would hope so, yeah. So, but these levels, just one interesting point that I continue to make is, so we're in a 10% correction. If you'd have shut your computer down last September and opened it up today, we're in the same place.
Right.
So those were
exactly the same.
Those were brand new highs, right. 5-6 months ago?
What is commonly referred to as a Trump bump.
Correct.
We've reset back to the prior Trump bump numbers.
That's exactly right. And so I think you're seeing a little bit of kind of uncertainty where it's like we're just back to new highs that we experienced just a few months ago. So that's the first. Now, here's what I'd say on the safety piece, and I've got some pretty powerful data to support this. Going back to 1972, like similar to the time frame you put, you just mentioned the compounding of equities at that period of time. If you held cash in a bank, the safest bank you can possibly find, if I gave you $1 million in 1972 and you opened that bank vault today, your $1 million is worth roughly $130,000. So, and that's nobody came in and took
right
$870,000 from you. What happened is the value of your dollar has eroded because purchasing power has gone down because things get more expensive, and there's reasons for that. But that is, and I know I've said this on this show before, but that is my biggest gripe is when somebody says, you know what, JD, I just want to be safe.
Right.
Park me in cash. I'm like, that is the furthest, especially in the environment we're in, that is the furthest thing from safe. And that's where, you're kind of speaking out of both sides of your mouth, but I just think most people have the wrong definition of what safe actually is.
I agree, JD. And for listeners, they're sitting there saying, well, $1 million is $1 million. What JD is referring to in 1972, if you had accumulated, if you had the wherewithal to put $1 million away, fast forward to 2025, you would have to have the same purchasing power. You'd have to have the wherewithal to put somewhere in the neighborhood of $6 to $8 million in a vault and put it away. And then fast forward, 50 plus years, and you would have the same effect. That is the effect of inflation. So JD, what we've established here is that, just from our simple example of what the NASDAQ and the Dow and the S&P has done over the last 50 years. And again, there has been gyrations. In fact, I mentioned on the episode that we talked about those particular indexes. There, you can point to the 2000s, 2000 to 2010, as a little bit of a lost decade in investing to some degree. Yep. Even though they eventually eked out some gains over it. That's often referred to as the investing lost decade. However, I think that we can prove mathematically that over any extended period that the stock market tends to go up and to the right. Doesn't mean it doesn't have volatility, but it goes up and to the right. So investors, JD, my question is, should investors take any comfort in that fact? If they will stay invested, history tells them that things will work out okay. Coupling that with having an honest conversation about what is a safe asset and what is not, as we transition to the ending of our first segment of this show, taking those two things, adding the third element is, well, what can you do other than just either if I believe you guys and I say, well, safe as I know it is not necessarily safe, but you also are sitting there and telling me that I don't need to necessarily just blindly hang on and pray as these things go through this thing. What is a third leg to this conversation, JD, about what can investors actually do about it versus urging the emotional reaction of heading to the exit door when every other investor is heading to the exit door?
Yeah, there's a couple things that I would say, and some of this is talk in our book, and I'll be careful on some of this, but firstly, you really need to think in terms of risk assets versus conservative assets. So think of your conservative assets as cash, CDs, treasury bonds, etc. Think of your risk assets as things like stocks. And what we would argue is, over time, your ability to compound capital, improve wealth in risk assets, like the data is incredibly supportive. So yes, you're going to have periods of volatility, periods where you don't make money, but it's the ability to be patient through those times that you earn the return that is coming. And I think we'll talk about the drivers of those returns. But what I would say, kind of the third part of this is, and this is our approach, we don't have the time the market approach. We don't have the just buy and hold, and because the one thing that we are very aware of is, if you draw down 10%, it requires you got to make another 20%. You draw down 50%, you got to make 100% to get back to break even. So drawdowns are devastating to the mathematics of compounding capital. So what we are huge believers in is we want to be able to own things that protect us if the market environment that everybody's concerned about actually does happen. So you get a 20+% drawdown. I need to have something in my portfolio. Maybe it cost me to hold it, but it sure pays me when things get really ugly. A lot of people, so that's a hedge. That's a market hedge.
Right.
And if we own these hedges and the market goes straight up, it costs us to hold them.
It's a sunk cost.
It's a sunk cost.
Right.
You can think of it, I won't use any other analogies.
A very marginal sunk cost, to be fair.
Correct. So like what we say is the presence of that payoff, the payoff from a hedge, when you need it the most, is what frees you up to own more risk capital. So those risk assets this is a simple example. If you had 50% in stocks, 50% in bonds, if you said, hey, stocks are going to compound at 7%, your bonds are going to compound, we would argue, at 0. Like real compounding, not, hey, I'm earning 2%, 4%, whatever it is. Well, you can earn that, but if your dollar value is going down 4%, you're earning nothing. Right. But we can talk about that later. But if you're 50% in something that goes nowhere, 50% in something that's compounding at 7%, aren't you significantly better off if you could say, why don't we put 98% in the things that are growing and 2% in a hedge? And if I chalk up 2%, if it goes to 0, oh well, I've got 98%, an additional 48% of my capital that's actually being productive for me. And that's our general thesis.
Well, and to go a little bit deeper on that too, while we're on that thread, not only have you make the prove mathematically and make the argument around the actual real return around bonds, which, to be fair, listeners, and JD can reiterate this, you don't say bonds never. Right. It's just maybe a little bit more heavier mix towards equities, coupled with the fact of what you're saying is, can you put in a mechanism that is going to help when there are significant drawdown on the equity side, arguing this? you and I came up in a very traditional training, financial training. I came up doing economics. You came up doing your financial training. We were told that bonds and stocks were uncorrelated. So my question to you is, has that been true? What have, when we have been told all these things, hey, do a 60-40, blended portfolio and you'll be just fine. Your argument is what related to that?
This is my argument. Best suited. I think that the traditional mindset of bonds do this when stocks do this and vice versa. Think about this. If you are an investor, I got two things to respond. First is there a place for bonds? And let me disclaim all of this. I know that I'm kind of on the one end of the spectrum when it comes to my conviction here. There is a place for bonds if you come and say, hey, I need to do this in a year. I need to do this in 3 years. If there's a timeline that's shorter than, say, 5 years, maybe we need to talk about fixed income bonds. If you say, hey, this is money that's I'm going to invest in, hopefully leave to my kids, maybe it's going to help me out in 20 years, there is no place for bonds in that world. Here's why. If you look at the Bloomberg 1 to 3 year Treasury Index, so basically short-term treasuries, it's as quote-unquote safe as you can get. The pre-tax return over the 25 years ending on 2/28 of this year, it's 2.6% annualized. The post-tax return, because remember you pay taxes on the money that treasuries pay you, is 1.7% annualized. Okay, that by itself sounds fine. Your post-tax and post-inflation, going back to the purchasing power, you're now, and I'm assuming a 35% tax rate.
Understood.
So if you factor in inflation into that, you've now negatively compounded your capital.
Right. You have a negative real return.
Yes. So your $100 back 25 years ago is now worth less, even though you've been safely earning interest from treasuries. You have to factor in, because that's what we always say, investors don't eat pre-tax returns and pre-inflation returns. They eat post-tax and post-inflation returns. And that's our point. The 1 to 3 year Treasury Index is the safest of all safe in the traditional sense of, hey, it's basically CDs, T-bills, things like that. That's kind of like the equivalent. So you've negatively compounded your capital.
Very good. And
but I've done it safely, Josh.
I understand. Yeah, I slept well. Yeah, I slept well at night. There you go. All right, well, listeners, I'm pretty sure we have your attention. So let me quickly reiterate the role that JD and his firm, Aptus Capital Advisors, serves with my firm, Gulf Coast Financial Advisors. Again, the technical definition is sub-advisor. I would argue to you all it's way beyond that. There is definitely a team atmosphere. The important part for you all to remember is that all my clients enjoy the incredible expertise and service that JD and his team at Aptus provides via portfolio management and investment advice. It is a team effort. In my opinion, it's one hell of a team. Now, for those of you that would like to start the conversation about your own personal investing and retirement goals and dreams, we encourage you to reach out to us. You can find us or call us at 251-327-2124 or visit our website, gulfcoastfa.com. That's FA as in financialadvisor.com. On our site, you can send us a direct message or click on the blue button in the upper right-hand corner. That will put a 15-minute introductory phone call on my calendar. Plus, for those of y'all that like to do business in person like I do, you can always schedule a no-obligation first meeting at any of our 3 convenient locations. That's downtown Fairhope in the Portico building, or Orange Beach off Canal Road, or Mobile near the intersection of Dolphin Street and I-65. Schedule a meeting. We'd love to meet with you. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week we scour the internet for financial articles related to our topic of the day, special articles that pertain to those of you in or near retirement. So join us after the break to hear JD and I discuss this week's relevant headlines with our news headlines of the week. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting in Retirement. Your host, Josh Null here. So as we discussed before the break, every week we scour the internet for helpful financial articles related to our topic of the day, special articles that pertain to those of you in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. Now note, if you want to read our referenced articles yourself, we include the article links on our show transcript, which you can find on our website, gulfcoastfa.com, under the podcast tab. We upload our new episodes every week after this show airs on 106.5 on Sunday and WHEP 92.5 on Monday. So with all that said, and without further ado, let's get at it with news headlines of the week. All right, JD, I'm going to do the headlines. You're going to do the reaction. Let's talk here, all right?
All right.
I got some, and this was, sometimes, I'll be honest with y'all, like every once in a blue moon, you'll have kind of a quiet news week. Not this week, not recently. It's been pretty easy. It's actually kind of hard to parse through which headlines I want to do. We always try to find things that are not paywalled, and we also try to find things that we think are fair with their analysis. They don't play one particular side too strong. So the first article is Yahoo Finance. It is titled, "A 4.5 trillion triple witching gives investors yet another test." So full disclosure to our listeners, we're recording this episode Friday, March 21st, which means that the triple witching activity we're about to discuss is happening right now. Right, JD?
Correct.
All right. So what I'd ask you is, can you help listeners understand what does triple witching mean in relation to options contracts, something you mentioned in the show opening? And apparently it happens every 4 Fridays, or on 4 Fridays every year. And I guess most importantly, should retail investors even be concerned about it?
Yeah, it's an interesting thing. We live in the derivative space, which we don't tend to lead with that because people say, I don't know what you just said. But
well, this is your third time on the show, so they're ready, man.
So we mentioned hedging in the last segment. That's obviously options based. So what triple witching is, it's not relevant for a long-term investor. It's to be aware of it and to maybe check out what's going on the day that it's occurring, because you can see some interesting things. What really happens, so the derivatives markets have used to be this kind of like corner of the market. Now it's a massive thing. And, predominantly because of, there's a lot of reasons for that. But you've got different types of column derivatives where you've got futures and stock index futures, stock index options, individual stock options, et cetera. Well, triple witching is when all of those things come to expiration.
On the same day.
And so all that really means for investors is, like you said, there's 4 times a year that it happens, and you tend to see huge spikes in like trading volume. And that's where sometimes that kind of increased activity can cause wild dispersions on the short term, especially when you look under the hood of the market. So that's all that's happening today is all those contracts are coming due, and you're having massive institutions either have to reset those, roll those, do different things with those exposures.
Well, and I think in a typical, say, a relatively calm trading week, so here we're on Friday at the end of the trading week, there's volatility going on today, but it kind of pales in comparison to some of the stuff we saw earlier this week. Fair?
Yep.
Yeah. So it's funny. It typically can be a big deal on the 4 Fridays that it happens, but in this particular situation, it wasn't. And back to what you were saying about it being a larger market, JD, I've told you this before, and I hope it comes across as a compliment because I mean it. But you were contrarian around these options and the hedging until you weren't.
Correct.
Do you feel like, not that necessarily you were the very first, but do you feel like you were a little bit on the leading edge of people that chose that philosophy to have these things around equities? How did that come onto your scene, and what's your thoughts on it now?
I would argue we were one of the first, if not the first, when it comes to options-based, specifically ETFs. I think that's we were kind of a first mover in that market. Obviously, we did it from Fairhope, Alabama, which makes it really unique. But I think the derivatives market is going to increase because of what we've already talked about. I think more and more investors are coming to the conclusion that for a long-term investment of my capital, maybe bonds aren't the best place. So how can I own something like the S&P or more equities, but do it confidently? And you have to, the only way to answer that question, in my opinion, is you have to have options of some sort, to mainly for protection. And that's what we do.
Very good. All right, JD, next up, let's pivot to familiar territory for you. On this show, we have often referenced your blog posting, the blog posting on your site, aptuscapitaladvisors.com. One, y'all do a great job. And two, it lets me, you all keep it very up to date. So what I want to do is discuss a very recent post that you all had called Aptus Musings, Perspective on the Market Pullback, something that's in my opinion, on the top of mind of most, if not all, investors right now. The article author starts off with bragging about your all's extensive basketball talent at Aptus, which is very true. Yeah, and you've gone the basketball. You even offer your March Madness winner predictions. I noticed nobody picked Auburn. Why is that?
Well, we don't have many Auburn fans in the office. I'll say that.
We're Eagle, man. Come on.
But you shouldn't ask me, because based on the first round, my bracket's already toast. I feel like normally I have a competitive bracket. This year, that's not the case. Clemson killed me. You're
not going to believe me. You have to see it for your own eyes. But my middle son Ashton's bracket is still perfect.
No way.
I'm not joking.
That's pretty impressive.
He's like one of the 0.2 of 1%. Yeah. So he is jumping out of his skin right now. Well, let's get back to the point of the show. All right, so back to your article. Can you give the listener a quick summary of this post, Perspectives on the Market Pullback? Specifically, I'm curious about your take on the section that says Trump may or may not have intentionally made international equities great again, which I thought was a great line. So tell us a little bit about the article and what you think about international equities, if you don't mind.
I think the article is relevant, obviously, to today. The first part of it is more focused on kind of what we've already hit on, which is, hey, these pullbacks are normal, pullbacks are expected. A little bit of the rationale of why the pullback is occurring. I think most people will point to the headlines and tariffs and things like that. In our opinion, it's more focused on growth. Like the market is a forward discounting machine, and that doesn't mean it's discounting things that it expects next week, but it expects out into the future. And so I think one concern would be growth is slowing, and that's, so we talk through a little bit, some reasons why that's the case. I would make the point, though, when you talk about the concerns, I think ultimately it further emphasizes what we think really matters for investors, which is, okay, because of our structural deficits, the fiscal position that we're in as a country right now, and I might ruffle some feathers, I'm not right or left.
This is a non-political show, and I let regular listeners know that.
So what I would say is, like, we're very constructive on a lot of things happening. I think what is misunderstood is like the Doge and Elon, and we're going to like reduce our deficit because we're cutting expenses. That's not the case. Yeah, I think getting rid of some fraud and some waste and things like that is obviously, I don't know how you could argue with that. But don't think that these structural deficits are going anywhere. Right. Like, because we could rattle off.
Well, one easy number is over 70% of our federal budget is towards entitlements. Well, and as you and I have talked about,
you have interest expense now outpacing Department of Defense spending. So these structural deficits aren't going anywhere, and that translates to what we were talking about earlier, which we should get into. But we
will on the fourth article.
Yeah. Yep. Our point is, maybe growth is slowing, and I think that's what's being discounted by the market right now. And we can point to a number of reasons, kind of why this correction is like, the characteristics of this correction is more pointing towards growth slowing than it is other reasons.
Well, here's one of the crazy things, JD. I've always argued the market can behave like a 13-year-old boy in any particular trading day, right? Very emotionally reactive. And we had a run-up on Thursday of this week where the market actually took bad news and absorbed it as good news.
Yeah, I would point out,
which is crazy.
Yeah, we didn't talk tons in this article, but I do think that there's some merit behind the idea of a lot of kind of the rhetoric out there. It's all around what the Fed's going to do with rates, because the market is, you've seen what's happening in the rates, even though the Fed has kind of stayed put. I think the risk asset, specifically the market, is really waiting for the Fed to cut. And I do think cuts are coming.
Yeah, I agree. I agree. Very good. All right. So next article, JD, I think it's fair to say that many investors are worried about a stock market crash. I would say after, and I know you've done this more years than I have, but after having done this job for so many years, that every year there's at least some investors worried about a crash, right? I mean, now some people are just predisposed to be the Chicken Little, if you will, but I think a lot of people have real uncertainty, and sometimes a lot of it is just the fact that they don't necessarily haven't had the opportunity to learn about the stock market to the depth that you and I have when we deal with this every single day. I can tell you, folks, that it's this particular fear, not to get off track here, but one particular irritation that JD and I have, we mentioned it earlier, is around fear-based selling. You know, you're seeing a lot of, the fixed index annuity guys are going crazy right now, brother, right? And as I've always said many times, it's not my job to agree with your confusion around how the market works. It's my job to help you understand how the market works so that even if you do decide that you still want to go with a product like that, which inherently is not necessarily per se anything wrong with it, there's argument either way with that, but at least you come in with it eyes wide open, not through the purchasing through a fear sell. Now, this article that we're referencing is kind of along that vein, JD, and I did it in hopes that it wouldn't irritate you a little. So it's called, it's from Forbes. It's titled, "Is a Stock Market Crash Underway? One Chart to See, One Call to Make." I can tell you listeners, our listeners, that if you combine stock market predictions and you had $2, at the end of the day, you'll have enough money to buy a cheap cup of coffee at the gas station. So I want you all to keep that in mind when I tell you that this author makes a decent case, an educated case about how we are headed for a crash and how he is currently, quote, 100% out of U.S. equities. So let's have some fun with this, JD, because this guy claims that he can time the market to some degree. You know, the old adage, as you mentioned earlier, it's time. Is it timing the market or is it time in the market? Your thoughts?
Yeah, definitely. So own the risk and hedge the crash. That is what we say. Because here's what we say. So this person is 100% out of the market. And by the way, if you look back at really any period of time, you could make a pretty compelling argument that a crash is coming, underway, whatever it is. Meanwhile, capital's compounded tremendously in equity markets. But here's the point that we have seen, we've lived. When you have, because we 08, you kind of had some craziness in summer of 11, craziness in 15. You had 18 Q4, 20% correction. You had 2022, which was nasty everywhere. So we've kind of lived through this. What happens is, hey, Josh, I'm going 100% cash. I'm scared to death of this market. Okay, let's say the market does sell off 20%. Guess what happens? Well, it's about to get worse, Josh. I'm going to just keep sitting on the sidelines. Like, it's really hard. Once you make the decision to go to cash, now you have to not only be right on the decision out, but you have to be right on the decision in. And the timing of that creates, like maybe you have a crystal ball. I don't.
No, I have a segment called Crystal Ball to make fun of the fact that I don't have a crystal ball.
Yeah, so that's kind of like these things are great at getting people to click on the links, and we get some wild questions from advisors when they find an article that seems to be pretty compelling. But I would say, back to what I said to start, is own the risk, hedge the crash. Well,
and one thing on this, unrelated to this particular article, but related to that discussion, JD, I think I mentioned this one time you were on the show. There was an article, gosh, it may have been on your old site, but there was an article, what would happen if an investor only invested in the S&P 500 during their favorite administration being president? And so it went back all the way to Eisenhower, and it said, okay, so in the times that you're whether you're Republican or Democrat, whenever your guy is not in office, you're sitting in cash. I'll give the listener the baby and save them the labor here. But basically, over time, the Republican return was somewhere in the neighborhood, I think, of like 8 or 10%. The Democratic return was higher because there's been more Democratic presidents. It was like 15 or 20%. But the point of the article was this: if you had just been invested during that entire time period, your total return was somewhere in the neighborhood of like 500%.
Yeah.
Right. That's how much money you left on the sidelines trying to time it right.
Yeah. Dave, who's probably the most colorful of the Aptus folks, his saying this week is politics and markets go together like lamb and tuna fish, which I don't know. I don't know if that's a Dave thing or if he got that from something, but I've heard it enough times that
that's not something my grandpa would say.
That's his saying when somebody says, "Well, I'm concerned about this administration" or whatever. like you said, it doesn't really matter left or right. Markets have compounded.
Yep. Very good. All right. Last article. So regular listeners will know that I often kind of jokingly tease about not about my economics degree. I'm very proud of that. I'm proud of the school I went to, Missouri State University, Springfield, Missouri. But sometimes I'll joke and call it the Harvard of the Midwest, Missouri State University. And it's not an Ivy League school. It's a fine school. I'm proud to be from there. Go Bears. But that said, during my economic studies, and I was a double major, by the way, JD, in case you didn't know, we often dived deep into monetary supply. But, as my life and my career moved on, I kind of stopped thinking about the effect of what the sheer volume of money, especially printed money, has on our economy and our markets. Honestly, until you reintroduced the topic to me several years ago. Again, here I'm supposed to be the economist. So for our last article, I want to discuss one from Barron's. It's got a recent headline titled, "The M2 Money Supply Posts Its Biggest Gain in 30 Months." And I'm going to remind listeners, this article is less than a handful of days old. So what I want to do, JD, is discuss what is monetary supply quickly, and more importantly, why should investors pay attention to what more or less boils down to the constant increasing production of money.
When you invest capital, when you think about your money being invested, there's a million things you can think about. We make the what I think is a compelling argument that there's only a few things that actually matter. If you get those right, all the other decisions don't matter. One of those is asset allocation. Do you own risk assets or not? And I would argue that the answer to that question is based, and I'm sure there's arguments, but I'm happy to go back and forth on this. But when you have structural deficits, the money supply, first off, the money supply is simply the amount of money in our system. Why does that matter? Well, it's simply this. I've probably given you this analogy. If I have the one and only Michael Jordan rookie card that's signed by MJ himself, only one produced, how much is that thing worth? Well, it's worth a lot.
Right.
If all of a sudden there's another 20 of those in the card system, well, the value of mine just went significantly lower because supply of it just went up. That's economics 101. It is no different from a money supply. What does it do to the cash that you hold? More money supply. So if you look at the most important stat that I could give you is if you go back to like 1960 and simply look at the growth of money supply. Why is real estate more expensive? Why is, if you go buy a new car, why is it so much more expensive than it was? Despite all this productivity, the way the world should work is productivity improves the dollar, like productivity injected into things should make your dollar buy more things. But our system is not built to withstand deflation in prices. Why is that? So think about this. This is what nobody talks about. Every time a new piece of debt is introduced into the market, new money hits so think about how much our treasury, we're operating at a 7 to 8% fiscal deficit right now. Well, how do you patch that 7 to 8%? You got to issue bonds. So what happens when bonds are issued? More money hits the system. This is the heart of our argument. The CBO, not JD or not Aptus, the CBO is telling us, hey, the debt levels are only going higher. And the reason for that is interest expense, entitlements. We have structural deficits. I don't care who's in the seat is going to fix. The only way to fix it's not going to happen overnight. Hopefully it does happen over time through growth and through really positive things. But until then, more money supply is going to hit the system. And if you don't own risk assets, we call bonds certificates of confiscation. You're saying, I'm going to be safe, and you're going to let the government confiscate your purchasing power because they have to. And
right.
that's like, there's a lot packed into what I just said. But
that's a fantastic, and I simplify the argument this way, JD, see if you agree. Michelle likes this analogy, but money's like water. It wants to flow somewhere. And what we've seen with, you and I have talked about the percentage number. I think it's 8% on average increase in monetary supply every year for the last 40 years, right? Something like that.
Somewhere in there.
It's a big number, right?
Yep.
And that's increased monetary supply. That's increased money that wants to go somewhere. Historically, what we've seen way back in the beginning of the show, we talked about the different indexes basically being pennies, fractions of fractions compared to what they are now.
Yeah.
that is a somewhat of, like you argue, somewhat of a result of productivity, but there's also just an argument. There's just that much more money sloshing around.
We have the best example I could give you, and John Luke's not here to defend himself, but I'm not messing with him. We actually produced this to present to one of our advisory groups. John Luke closed on his house down here in Fairhope in 2019, and we did a Zillow estimate of what his house is worth now. He's made like 50% in value of his house.
Okay.
Like it's I've got the slide. I can send it to you.
Michelle did the same thing, by the way.
So
a very similar number.
And our point is I think this summarizes kind of a lot of what I've said, is John Luke could look at that and say, I'm up 50% on my house. Man, this has been a great investment. But then what John Luke shows is the money supply is literally up 49% since John Luke bought us. And so that's our point, is like, okay, have you made 50%, or has your house, because it has limited supply in the face of ever increasing supply of our money, like, has your house just helped you to maintain? And the answer is maintain.
Yep.
But a lot of people are like, I can't understand that. My house is worth 50% more. I'm like, well, your dollar is worth less.
Real return matters, man.
Exactly.
Well, great job discussing the headlines. I know I learned a lot. I'm sure our listeners did too. Speaking of listeners, I hope you all are picking up what we're setting down, that Gulf Coast Financial Advisors and Aptus Capital Advisors make for a solid team. We got great processes related to your financial planning and your investment management needs. I encourage you, those of you that want to continue the conversation, pick up the phone, give us a call, 251-327-2124, or go to our website, Gulf Coast as in financialadvisor.com. Upper right-hand corner is a blue button that puts you on my calendar. Or better yet, reach out to us, schedule an in-person conversation. There's no cost to it. Any of our 3 offices, downtown Fairhope, Orange Beach, or Mobile. All right, folks, coming up next, Josh's Crystal Ball and Big Mouth. What have been some of my predictions? Have I been right? Was I ever wrong? JD, I got to tell you, how much I love seeing people with zero experience around a particular issue, lecturing, bloviating, and predicting about said issue online, particularly on social media. I don't know if that just thrills you as much as it thrills me. Yeah, I had no idea there was that many trained economists in America. Now, of course, I'm jesting and being a little bit of a smart aleck. And the few times I pay attention, I probably a little get, with a radio show, I get a little overly sensitive about it. But listeners, if you want to hear a little context about issues that JD and I actually know a little something about, I encourage you to stay tuned. Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. All right, welcome back. Your host, Josh Knoll, here alongside guest co-host J.D. Gardner. So J.D. and I, we're opinionated. We tend to be aggressive. J.D.'s still aggressive on the basketball court. I got too old. But I would always argue that a radio show host that isn't opinionated would be very boring to listen to. Plus, J.D. and I are paid in our respective professions to offer our professional guidance and opinions to our clients. Otherwise, I guess you just replace us with AI. So sometimes we'll make some predictions on, public. Sometimes we'll swing and miss. This time, what we're going to do, JD, is with you here, I wanted to make a prediction. I'm going to, as we close this show, we got a few minutes left. I want to have a little fun with this. Michelle and I did a show a few episodes back about the history of the indexes with the stock market. And she pressed me or particularly around the S&P 500, because I've always argued to her, there's nothing wrong with the Dow Jones, but you're only talking about 30 companies. The NASDAQ is pretty broad-based. That's a good measure in my opinion, but it seems like a lot of things that we do, it seems like S&P tends to be one of the more, at least important ones for the regular retail investor to pay attention to. Do you agree, disagree?
Agree.
Okay. So she pressed me. Now, when we did the show, the S&P was sitting at 6,000. It was in the middle of a Trump bump. Where would it be at the end of the year? I said it's going to be one hairy ride, but we'd end up at 6,500 is what I guess. So I'm curious, as we got about 30 to 40 seconds here, what's your opinion on where the S&P is going to be? What's your prediction so we can make fun of it at the end of the year?
Yep. My prediction, I'll give you first a general direction, and then I'll give you a number.
All right.
I'm saying general direction is it is going to end the year much higher than what it is right now.
Okay, so way more optimistic than I was.
And I'm saying we're plus 20% from here. If my calculators,
well, that's what it did last year, right? When things were terrible, right? So
it puts us close to 6,800.
I'll be down. Okay,
that's
all right.
What I'm.
So we're Price is Right, folks. Tune in because JD will be a regular. We'll save this one towards the end of the year. If you go over the number, JD, you lose. So I'm at 6,500. You're at 6,800. We'll see where we end up. Very good. Well, listeners, I hope you enjoyed the show today. I hope you enjoyed how JD and I form our opinions and our respective expertise and experiences. We invite you, if you'd like to continue the conversation, we want to invite you one last time. Give us a call at 251-327-2124 or go to the website Gulf Coast FA. Again, that says FA as in financial advisor.com. On the site, there's a blue button, upper right-hand corner. That'll put a 15-minute introductory phone call on my calendar. Those of you all that want to meet in person, we always encourage that. I like that. You can also schedule a no obligation, no BS first meeting at any of our 3 convenient locations. Again, downtown Fairhope in the Portico building, Orange Beach off Canal Road, just down the road from the wharf, or Mobile near the intersection of Dolphin Street and I-65. We'd love to meet with you all. Well, folks, that is a wrap for this week on Coasting in Retirement. I want to give a huge thank you to my guest co-host. He's a very busy man, JD Gardner of Aptus Capital Advisors. Thank you so much, man.
Thank you.
I knew the timing of this would be perfect, and you crushed it like always. Thank you so much. Thank you to our 2 awesome radio show stations. That's FM Talk 106.5 out of Mobile, and fairly new, although we're getting some time under our belt, WHEP 92.5 FM /1310 AM out of Foley. Thank you to our awesome show producer. That's my son, Peyton Knoll. Many thanks to the provider of our show music. That's a local band, Sloth Racer. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd love to be part of your journey as well. Till we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and/or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and/or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.